Hello and welcome to day 2 of the Moss Adams Private Foundation virtual conference. We are pleased that you're able to join us. We have 4 sessions today, totaling 5 CPE credits for today's portion of the conference. For the National Association of State Boards of Accountancy, to qualify for these credits, you must attend the 1 credit sessions for a minimum of 50 minutes and respond to at least 3 polling questions. For the sessions offering 1.5 credits, you must attend for a minimum of 75 minutes and respond to at least 5 polling questions. Before we get started, I'm going to play our brief housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, there's a link to the agenda in your handouts window, and during the 40-minute break, we will be switching to the afternoon sessions. There is a link in your console that will take you directly to the afternoon sessions. However, if you have trouble with that link, you can also find it in your email and calendar appointments. And now I would like to turn it over to Wendy Campos, Partner and Foundation's National Practice Leader, to get the conference started.
Thank you, Amy, and thank you for joining us for day 2 of the Moss Adams Private Foundation Conference. If you joined us yesterday, welcome back. And if you're new to day 2, thank you for joining. We hope you had some great insights from yesterday's session if you were with us. I also wanted to let you know that we're recording all of the sessions. So if you missed any of the sessions yesterday, or if you miss any today, we'll be sending links to the recordings after the conference. We'll also be posting those recordings to our website. We have another great agenda planned today with an impressive lineup of speakers, and we hope you're all looking forward to it. With that, I'd like to introduce Matt Parsons, Moss Adams partner, to tell us a little bit more about our first session.
Great. Thanks so much, Wendy. I'm really excited for today. We're going to start the day with a discussion on some of the leading trends in giving and their impact on philanthropy. We'll also explore how some nonprofit endowments are managed and the key forces that are shaping the environment. Joining us today are 3 esteemed speakers from Bank of America. We have Dianne Bailey, the Managing Director and National Philanthropic Strategy Executive, Michael Strauss, Managing Director and Senior Investment Strategist, and William Jarvis, Managing Director and a Philanthropic Executive. Dianne, Michael, and Bill will share their insights on these critical topics and discuss some implications that they see in the future for the not-for-profit sector. I'll turn it over to Dianne to get the session started.
Many thanks, Matt, and to the entire Moss Adams team for welcoming us today. We're thrilled to be able to bring you both insights from our research and also our experience related to philanthropy, both strategy as well as investments. So I will get started by sharing some insights from our Bank of America study of philanthropy. I hope many of you are already familiar with this research. We've been conducting it for almost 20 years with the Lilly Family School of Philanthropy. This research looks into the motivations, strategies, practices of affluent Americans. And we define affluent for purposes of this study using the accredited investor standard. Many of you will be familiar with this standard. It's based on a test related to both income or wealth. So for individuals, $200,000 is the minimum threshold. For households, it's $300,000. And for wealth, it is $1 million in assets outside of the value of your primary residence. It's important to remember that this is an or, not an and test. So it's a fairly inclusive group of affluent Americans. When we look at this research, it's important to contextualize it in the macro ecosystem of giving. So that number that you see on this first slide, that $557 billion, that's not the money given only by affluent Americans, but rather that's the amount given by all Americans in 2023. It was a high amount. However, when you adjust it for inflation, it did represent a small pullback in giving overall. Very much related to challenges in the economy, we believe. Certainly going back to 2022, seeing volatility and retraction in the market. But then even in 2023, that ongoing impact of interest rates and also inflation. It's important to keep in mind that that pullback in inflation-adjusted dollars was only one of 4 in almost as many decades. So while a healthy aggregate number, it does represent some tension on the philanthropic system. Keep in mind that of that $557 billion, over 80% of that, when you count family foundations in that number, was given by individuals and families. A relatively smaller percent of the giving overall is from corporations, including their foundations, but more broadly, as well as institutional foundations, those foundations that have independent boards of directors that are more distant from a closely held group of family members controlling those assets. The reason why we look at affluent Americans and their giving so closely through our consistent use of the Bank of America study of philanthropy is really twofold. One, there are clients. As you'll hear more at Bank of America, we're a global financial services firm, I'm sure as most of you know, with 8 lines of business. Bill, Michael, and I specifically sit on our foundation and endowment investment management team, really specializing in outsourced chief investment office, discretionary fiduciary management of long-term investments. But we're part of a broader wealth management platform that also works with individuals and families. And these individuals that we study are our clients. That group gives on average $35,000 a year. This is data from 2022. I'm now transitioning to the Bank of America study of philanthropy data. That compares to just $2,500 from Americans overall. So what this data tells you is that the affluent Americans, understandably, are critically important to nonprofits' ability to achieve their fundraising success. Before I talk about the patterns and practices of these wealthy Americans and their giving, I do want to talk about Americans, both wealthy and from the general population, who are not giving. A very, very important and concerning trend that we continue to see in the US is a declining donor participation rate. You see it on this slide. If you look at the bar on the top, where you see the 91% drifting down to the 85% participation, that is giving from affluent Americans, those accredited investors that we study in our research. If you were to stretch this chart back to 2006, when we started the study with the Lilly Family School, at that point, before the financial crisis, before the Great Recession, at that point, 98% of affluent Americans were giving to charitable organizations. And that number now, in 2022, was down to 85%. 85%. We've seen similar declines in the general population. Again, stretching back to 2006, over 2/3 of Americans were prioritizing charitable giving year over year, and now it's down to less than 50%. So nonprofits are increasingly relying on a smaller and much more affluent circle of donors to achieve their fundraising goals. So let's comment briefly on the why for the declining donor participation rate. We asked affluent donors why they didn't give to charity in 2022. And as I've already alluded, that was a difficult year, both in the markets and the economy more broadly. And not surprisingly, the number one reason why people said that they did not prioritize giving back to charity, that 15%, the number one reason of that 15% was that prioritizing caring for their family was a higher priority. And likewise, that they felt like they just didn't have the resources to give to a charitable organization. Now, mind you, these are people that have at least $200,000 in income or $1 million in investable assets. And in fact, the number that comes back to us on average is substantially higher, with $500,000 in income or $31 million in investable assets. That's a mean, not a median, but a quite higher number. And yet these people still felt like they had inadequate assets to be able to both provide for their family and their household needs and also give to charitable organizations. There are reasons on this slide that are subject to the influence and really even the control of nonprofit organizations in terms of unlocking this capital that's on the sidelines. And if you look down to reasons 4 and 5, you'll see them. I didn't have a connection to an organization, or simply I was not asked to give. But the financial pressures are not the only reasons why we believe that there is declining donor participation rates. Again, we've seen this over a long period of time, including years where the markets and the economy were quite healthy. One of the reasons that we believe that there is this declining donor participation is what we refer to as the substitution effect, that people are using their capital to achieve social impact goals using mechanisms other than traditional charitable giving to nonprofits. An example of this is sustainable investing or impact investing, when you align the assets in your non-cash portfolio to your goals. For example, you could make a decision in your public equities portfolio to move toward companies that have favorable practices benefiting women and girls, whether that's representation in their board leadership, in their professional leadership, benefits provided to their employees. There's a way to tilt that portfolio to achieve your broader social impact goals. Now, for most people, this tool around sustainable or impact investing is additive. It's just another lever that they pull to achieve those social impact goals. But for a few, roughly a quarter, they use sustainable investing as a substitute to charitable giving, either in whole or in part. So that substitution effect could be contributing to declining donor participation rates. In addition to sustainable investing, conscious consumerism is another substitution for charitable giving. Here again, this is conscious consumerism being where you align your purchasing decisions, whether it's goods or services, with companies that have values that you share or achieve social impact goals that you prioritize. Here again, 25%, there is a bit of a substitution effect, either in part or in whole, substituting for charitable giving. Another possibility is changing patterns in religion. I don't have a slide for this observation, but you'll see evidence of it as we move deeper into the deck. And we know that participation in organized religion, whether that be a synagogue, mosque, temple, or a church, is declining. According to Pew, the number of nuns, the percentage of nuns, N-O-N-E-S, not N-U-N-S, nuns, N-O-N-E-S. So either atheist, agnostic, or spiritual but not religious, that number is increasing. It's roughly 30% at this point. And we know that traditions of benevolence are taught and practiced in these places of worship. So we believe that changing patterns of religion could be contributing to a tradition of benevolence that extends more broadly than just that place of worship. The last observation I'll make, which we think is a very, very important one, is shifting patterns of trust. In general, there is a declining level of trust. This is acutely apparent with the rising generation in institutions of all kinds. And you see that reflected here on this slide. Now, it's important to point out that on a relative basis, nonprofit organizations do enjoy the highest level of trust when you compare them to companies, all forms of government, including the courts, Congress. You see them languishing on the bottom there at 4%, having a great deal of confidence in their ability to solve social problems. So nonprofits are at the top of the list, even edging a bit ahead of individuals. However, only 21% have a great deal of trust in nonprofit organizations' ability to solve problems and to achieve social impact goals. And so necessarily this lack of confidence and lack of trust associated with that could have a chilling effect on giving. So with the bad news behind us, let's talk about who actually is giving. And we know that affluent Americans are not a monolith, that they certainly have differences in practices and patterns based on their demographics. For example, we study gender, race and ethnicity, age, with a real focus on millennials and Gen Z, as well as LGBTQ+ status. And really what I want you to carry away from this slide is that across the board, all of these demographics are quite generous. They all are prioritizing giving back. Particularly when you compare it to the giving overall, remembering that the 85% is the overall marker for participation from affluent Americans, compared with that 49%, so less than 50% of the population overall. I'll point out two things on this slide, just to highlight some of the more relevant differences. Again, with the baseline that all of these individuals are generous. Typically, we would see women outpacing men in donor participation rates by roughly 6 points. That was what we saw in our prior studies. However, 2022, which is this data, was a very, very unusual year in terms of the markets and the economy. And we did see a significant pullback by women in their giving, making them not ahead of men, but on par with men in their giving. It'll be very interesting to see when we do this research next year, looking at giving in 2024, whether that delta is established again, with women going back to that traditional pattern of outpacing men in their participation in giving. What I also want you to see on this slide is that the millennials and the Gen Z-ers are already prioritizing giving back. Roughly 4 in 5, almost 80%, already are prioritizing charitable giving, which we think is a very strong indicator for their generosity to come in the future as well. So we've talked about who is giving with the baseline of who is not giving. So I want to talk now about where they're giving, what organizations they're prioritizing, what causes they're prioritizing in giving back. And we're going to show you two different looks at this data. The first two slides relate to incidents of giving. So this is just a popularity contest. Which kinds of organizations attract the greatest number of gifts? This is not proportionate giving. This is not the wedge of the pie. This is just the number of gifts. So on this slide, a $10 gift and $1 million gift would show up exactly the same way. It's just the number of gifts. And consistent with prior years, basic needs carries the day. People really are focused on providing for food, housing, just those basic needs for individuals and certainly for families. We saw this category jump to the top of the list in the Great Recession during the financial crisis, and it has not changed. Really, people have continued to be very, very supportive of those basic fundamental needs. Religion, and this is giving to places of worship. This is not giving to religious organizations that provide other services. This is purely your membership in a house of worship. That does continue to be a popular category, but look at that pullback from 2020 to 2022, a really significant contraction in the number of gifts that are given to places of worship. The thing to notice about this slide is then when you get into these other categories, health, youth, animals, arts and culture, education, whether it's K through 12 or higher education, you see a broad, fairly even distribution from the low 30s to the mid 20s in terms of percentage of giving to these causes. So really evenly distributed. So I want to ask you a question. Here's our first polling question before we get to our next slide. When you are focusing your charitable giving, are you focusing it on the local level, A, the state level, B, the national level, C, or internationally, D? I think Amy's going to give you a little bit more guidance about how to submit your answers.
Yes, thank you. So what you're going to do is you're going to click the button next to the answer you choose, A, B, C, or D, and then make sure you hit that submit button so that it tracks your response for CPE purposes. And we'll leave this up here another 15 seconds or so to make sure everyone figures out how to respond to the first poll. All right, Diane, here are the results.
Yep, you are right in line with the affluent Americans that we research as well. This is really fascinating. Wait till you see how closely you line up. Look at that. Isn't that amazing? Bill, I know that you're on mute, but Bill Jarvis, you'll get to know in a minute, and I are great partners in this research, and it's wonderful to see this validation with this particular sample. So overwhelmingly, we see affluent individuals and families prioritizing their local communities, really leaning in to their neighbors to provide for their needs and to really open doors to their opportunities. The next most popular category, and again, this is an incidence of giving slide, is the national level giving, really wrapping your arms around those organizations that are at scale, looking at issues from a national lens, and really lagging behind our state and international priorities. So here's another one. We'll see a version of this. Amy, I don't know if you want me to walk them through the options, or I can defer to you.
Either way.
Okay, I'm happy to walk them through. So the second question,
okay.
we won't see exactly the matchup with the data as you did the last time. But when you're looking at if you're considering organizations for charitable giving, is your priority the organization, the institution, the specific organization that you know and trust, or are you looking more broadly at issues? B, so A, organizations, B, issues, or C, geography. Again, really focusing in on your specific geographic area, whether that's local, state, national, or global, or do you have other considerations that would really top the list?
All right, we'll leave this up a few more seconds While you're responding, I do want to remind the group that you do need to respond to at least 5 of the 6 polling questions that we pull up throughout this presentation to qualify for the CPE. And here are the results.
So this is an interesting look. If I had to guess, it's possible that the age of the participants in today's program is slightly younger than average. So there would be more millennials and Gen Zers, maybe young Gen Xers in the virtual room today. And I say that because issues-based philanthropy is more popular with younger donors in general than organizations. Those younger donors tend not to have a loyalty that is without question, a sense of duty in giving to particular institutions like their alma mater or local hospital or United Way or other federated giving institution. We're really seeing them move more toward issues where you're really giving through an organization to impact the issues that you care about, rather than giving to the organization because of a sense of duty or a particular loyalty to that institution. So this slide is the last slide that we have today on where these affluent donors are giving. And this is importantly a look at the wallet share. So this is proportionate giving. And remember, in that slide that has all of these same categories that I showed you earlier, there was really very broad distribution in participating in these different categories. However, when you see where the dollars are really flowing, you'll see the 3 categories at the top are far outpacing the wallet share relative to some of these other categories. Remember, the participation numbers were in the low 30s, mid 20%, and the wallet share is in the mid to low single digits. So people are really over-indexing a few categories, and I'll explain to you what those are. The first is religion. Remember, we've talked about the declining, the rise of the nuns overall, the declining participation in religious giving to places of worship. But look in 2022 how significant the wallet share is, even increasing over 2020. And so what that tells you is that those people that are giving are really over-indexing religion in the proportionate amount given relative to these other categories. So for those religious donors, those ones that are still standing, their gifts are 6 times higher on average than the next highest category. So really significant, passionate giving by those people who are still participating in giving to places of worship. The next 2 significant categories are higher education and basic needs. Now, you'll note that there's almost an inversion of how those 2 categories ranked in 2020 versus 2022. In a typical year, like 2022, we would see higher education be second. So that group of institutions that are commanding those large investments, those significant gifts. However, I don't need to remind you what 2020 looked like as a year. And that was a year with the pandemic in particular, where we saw giving to neighbors in need who were losing their sources of income with the disruption of the pandemic. We saw really an over-indexing in 2020 to basic needs. Again, it'll be interesting to see in 2024 whether this reversion to the prior practice of higher education ranking second, whether that will continue, and also what will happen to religious giving, given what we know related to declining donor participation rates. And so then you see all of these other categories with the precipitous drop-off in terms of the wallet share. You know that, that gifts are not evenly distributed, right? That there is a real over-indexing in some categories. So a wonderful opportunity for self-awareness among donors, but also a thoughtfulness with nonprofits about how to position your case for support toward some of these more popular categories like basic needs or education. All right, we've got another polling question. So as a donor, do you monitor the impact of your charitable giving? Simple yes or no. A, yes, B, no. Do you take the time to measure or review reports around whether your giving is having the intended impact? Is it achieving the goals that you desired with your giving? So yes, here again, very, very similar, slightly, more evenly split here. But for the most part, the majority, a slight majority, say no, they're not monitoring. If we'd asked the question in a slightly different way, I think we might have seen something approximating this. It's not only whether you monitor, but whether you perceive that it's actually having an impact. And most people just don't know. They don't know. And shame on the nonprofit organizations to which those gifts have been entrusted, because the number one reason why people know whether their giving has had an intended impact is because of the organization to which they contributed. So it's a real reminder of how important the impact reports provided by the nonprofits are, and how they're either not received or not read, because most report that they really don't know whether their giving is having the intended impact. We also ask donors who participate in our survey about what factors they think are important after they make their gift. And I'll just point out one on this slide because I think it's a very important point of education. And it's this category on the top left under the 5 top reasons that responses that you think are very important, something that really matters to you after you make a gift. And the number one answer is that the organization only spend a reasonable amount of the donation on general administrative or fundraising expenses. Now, this is a point of education for donors. There is in the sector a fairly widespread belief that nonprofit employees should be paid relatively modestly. I think there are a lot of reasons why people believe this, and I will not pontificate about all of them. Certainly something we could talk about in Q&A if you're interested. But what it does is it imposes on nonprofits very arbitrary expectations around how much money will be spent on programs versus overhead. And what we try to help our clients who are donors understand is at first, there's no one size fits all. That every organization, depending on its life cycle, depending on how unpopular or popular it is, so how challenging the fundraising is or is not, depending on how the programs are delivered, that there is no arbitrary percentage that would ever apply. And even more importantly, people are not overhead, people deliver programs. And so having the right people in place is really is critical to achieving your ultimate goal, which is impact. And third, there's really important research from independent sector around how the relative undercompensation of nonprofit professionals and employees of all levels, how that undercompensation creates stress in those employees and ultimately fragility in the organizational model for the nonprofits, which could in fact make it more difficult to achieve your impact goals. So really, we try to bust the overhead myth and help donors understand that this starvation cycle that has been imposed on many nonprofits is often counter to your ability to achieve your social impact goals. Of the donors that give, there are a few that take one or more organizations off their list year over year. It's a small group, but we do ask those individuals, why? Why did you take an organization off your list? Interestingly, the number one reason why is because they've been badgered. They've been asked too many times or in too rapid a succession for additional contributions, and they finally just determined they've done enough and they stop giving as a consequence. Certainly there is a competition in the marketplace for nonprofits, and so sometimes they decide they just want to pick another organization that they think is better positioned to achieve their goals. This certainly is related to those issues-based philanthropists, right, that are not giving to organizations, but are rather giving through organizations. But the other thing, the third most popular reason, is really just related to the individual's circumstances, that they didn't have the means to give. Again, this is really significant in 2022, the year of this data. Maybe they moved, so they were looking at different organizations in their new community. So really factors that are external to the nonprofit and based more on that particular individual's circumstances. I like this slide because of the refreshing humility that it shows. This is where we ask people how they rate their own expertise as it relates to charitable giving. And you'll see that on average, 5% say they're expert. So a very, very small percentage. The vast majority either say that they're knowledgeable or just declare that they're completely a novice at it. It's a wonderful opportunity for education for donors to be more sophisticated about their giving. And when nonprofits lean into providing this education or individual donors prioritize seeking it out, whether it's from their wealth advisory firm or from other places, what happens is the further they go on the spectrum of expertise, when they get to the place where they're self-declared experts in charitable giving, they're much more likely to monitor the impact of their giving. They're much more likely to believe that their giving is having the intended impact. They're more likely to have a plan, a budget for their giving. And guess what? Look at that light gray bar. They give more, and a lot more. So certainly well worth the investment to build their acumen and expertise, particularly if you're working with a nonprofit organization. Now, I want to talk a little bit about how wealthy Americans are giving, affluent Americans are giving. And this is critically important for the individuals that are on the line today, because it is this point of education. What this slide tells you is that affluent donors, notwithstanding their income or their wealth and possible associated sophistication, perhaps likely associated sophistication, they are not leveraging their assets in a strategic way to achieve their giving goals and to maximize their tax benefits. What we know is that most giving, that 96%, is just from disposable personal assets, checking accounts, and credit cards. You also see significant interest in giving in kind, so those donations of goods to Goodwills and other resale shops. These other in-kind contributions of non-household and non-cash these in-kind contributions of securities, art, vehicles, cryptocurrency, closely held business interests. All of those are in the low single digits in terms of the percentage of people that are leveraging those assets. And while 2022 was a difficult year in the markets, it came on the heels of a decade or so of really healthy returns in the markets. And so undoubtedly, many of these donors could have achieved their goals, both for social impact and for efficient tax planning, by giving appreciated securities. So a real point of inquiry and for value add, working with clients to structure their charitable giving using assets that are more tax advantaged. So when we look at the sources of donations, whatever form they're taking, although we know they're primarily cash, again, usually they're direct gifts. Roughly 4 in 5 are just making gifts directly. However, another 20%, roughly 1 in 5, are using giving vehicles to intermediate their contributions, donor advised funds being particularly popular. So we do dig a little bit more deeply into other giving vehicles, not just the donor advised funds and the private foundations. And the number one popular way to move money other than direct assets to charitable organizations are bequests. So whenever you're working with nonprofits, certainly when you're working with individual donors, really prioritize the simplicity of a provision in a will or a trust instrument as a way to achieve social impact goals as part of your legacy. So after your death is really, really critical. We know that giving vehicles are embraced the wealthier you are. And so we do segment our Bank of America study of philanthropy data by wealth. So the minimum to participate is, again, either 200 in income or $1 million in assets outside of the value of the primary residence. When you look at household wealth that's between 5 million and 20 million, you see, certainly the majority, 60% of them either have or do plan to establish a giving vehicle within the next 3 years. So, challenges to charitable giving. We've already talked about many of the obstacles to giving overall, but for those that are giving, where do they see the challenges to their giving? The main priority is really narrowing down their strategic vision to really decide what is it that I care about, where I want to prioritize giving back. And that's where the philanthropic strategy team that I lead and other philanthropic advisors are so helpful to really curate conversations, to be able to create space for discernment so they can find their calling in their charitable giving. So we've talked about who's giving, who's not giving, where they're giving, how they're giving. I want to talk a little bit about the charitable decision-making, sort of how you get to that place to be able to make these gifts, and ultimately looking at the why of giving. So who makes these decisions in affluent households? I think the main thing to take away from this is it takes 2 people to say yes and 1 person to say no. That most giving decisions are made either as partners in a married or partnered household, or at least conferring with one another. So another way to think about this is that women either make or influence 85% of all giving decisions. So very important to engage both members of a partnered household, particularly if you're looking to leadership or a major gift. Most decisions are really made at that partnered level, right? So those people that are heading households that contain only their or one other generation. 17% are involving younger relatives, children or grandchildren, I would love to see this number increase and increase dramatically, because we know that with the great wealth transfer, $84 trillion coming down the pike, 11.9, almost 12 trillion already earmarked for charitable giving, that using philanthropy as a way to prepare that rising generation to receive this wealth is a wonderful way to ensure that the assets of the family, even the non-philanthropic assets, are also stewarded. So we would really, really love to see this number increase. The other number we'd like to see increase is that number that are involving older generations. You'll see on the bottom of the slide, only 2% are involving older generations, really leaning into the wisdom of their elders in their giving. So certainly a missed opportunity there. I've mentioned the wealth transfer, that $84 trillion, and you'll see that and that's a blended number. That's all people, not just wealthy people. And you see those patterns, those percentages between money given to children and grandchildren, and then other heirs that are individuals. That lines up very, very closely with what we see in the general population in terms of the breakdown between charitable versus to individuals. Interesting that to look at the difference between religious charities and wills versus secular charities, with about a third going to religious organizations now. It'll be interesting to see how that changes over time. So this slide, I think, is the most important one. I told you it was coming. This is really, really critical information, and that's the why. Why? Why do people give? Why do they choose different causes or different organizations to support? And the big aha here is it's really about the donor. It's not about the recipient organization, right? The number one reason why people give is because of their personal values, whether it's a religious, political, or philosophical belief. Their personal values are animating their giving, as are their personal interests. Their interest in the issue area is the next most popularly cited reason for choosing a cause or an organization. Note that you have to go all the way down to the third from the bottom. Only 12% say it's about that organization's compelling pitch or case for support, right? Now, as a donor, it's important to be self-aware that it is your personal values and interests that are animating your giving, and really taking that extra step, really prioritizing, finding out how your personal passions align with the greatest needs and priorities of your community, because that intersection is where giving is the most impactful. Before I stop, and I know that we've got really important content that you want to hear from Bill and from Michael as well, I want to do a quick little side note on volunteering. We don't just ask about giving, we also ask about volunteering. And here you'll notice that women, which is consistent with prior studies, significantly outpace men in their willingness to volunteer for nonprofit organizations. Again, I want to call out the millennial and Gen Zers. I love the fact that 30% of them are already prioritizing volunteering with organizations. Certainly, that can be a very busy time of life with building careers, raising families, lots of demands and competition for their time, and still they're prioritizing 31% of them giving of their time. So I think that's very, very encouraging for the future. One side note about a way in which these individuals volunteer by serving on nonprofit boards, you see pretty significant swings in board service. I'll note in particular that the millennials, while they do volunteer at roughly even amounts, they do fall significantly behind in their board service. Now's the time to bring millennials and Gen Zers on your board. They bring a world perspective, definitely acumen, and certainly they will be coming into significant wealth. So now's the time to bring them closer to your organization. But look at the bottom and look at the gender disparity in board service. So remember, women are 9 points more likely to volunteer, almost 10 points more likely to volunteer. And yet, men are twice as likely, almost twice as likely to serve on a nonprofit board. To the extent that boards do have gender parity, and many do, the question becomes whether women are simply being recycled, a small group of women, from board to board to board. So a real opportunity for inquiry with the organizations for whom you're either serving on the board or advising. This is the why for volunteering. Remember, the why for giving is personal values and interests. So different here, the why for volunteering is responding to a need. So a need in the community, the need for your organization is a way to attract new people to learn more about your mission. And your efforts to bring in volunteers will be rewarded, because as my friend and colleague Bill often says, and it's so compelling, volunteering is in many respects a gateway to giving. And in general, volunteers give 2.5 times more than non-volunteers. So very, very important for organizations to prioritize these intentional volunteer programs. Last slide for me is the one that I love the most. And this is a reminder about how life satisfaction correlates, is associated with giving and volunteering. And what I would say, in a world where we don't seem to agree on too much, we do agree on one thing, which is that giving, and in particular volunteering, make us happy. So for you, in your individual capacity, we are in giving season after all. I do encourage you to create space to be intentional about where you will be giving personally, and certainly volunteering as we end out, close the curtain on 2024. But as you're working with clients, I want you to prioritize conversations around giving and volunteering, not only because you know that it's at the heartbeat of what affluent Americans are prioritizing, but also the endorphins that it'll bring into the room. You'll see them smile, you'll build relationships by hearing their stories. So just remind yourself that giving and volunteering do strongly correlate with life satisfaction. So with that, I think we might have a moment or two for some questions, but I know that you also want to get to the very, very important reflections that Bill and Michael will bring. Amy, would you like to let people know how they can ask questions?
Yes, the questions are being submitted through the Q&A window.
Okay. I see. Okay, let me pop open this box. Okay. Yes. Shirley, thank you for this observation about the recognition that fairly compensating is so important from a grant maker's perspective. Thank you for sharing that. Any thoughts on the significant decline in social justice giving from 2020 to 2022? Yes. We had all hoped that it would be a moment, it would be a movement. It would be a movement, not a moment, with the social justice giving that happened in 2020. However, as giving is with giving that is in response to a headline, so reactive or responsive giving, whether it's a natural disaster, a mass shooting, global unrest, a Supreme Court case, we typically see a flurry of interest and activity as long as those headlines persist, which in many instances is weeks, maybe months. And then when the news cycles move on to the next, you do see giving decline. And so while many hoped that that social justice movement was being fueled in new ways, what we are seeing is that there has been this distraction and donors moving on to other causes, which is not atypical. It's something that we see across the board. A question about whether religious organizations are so trusted to implement programs that help the community. Could they continue to be a high priority in giving? I think yes, with people that are members of those organizations, but we don't see anything to suggest that they would be conduits for non-members to achieve social impact goals. Not a reflection on whether that would be a viable strategy or not. It's just not something that we see. Has there been any research about adjusting what defines affluent donors? I am so glad you asked, because indeed, we have a whole other body of research, the study of wealthy Americans, which looks at giving among other areas of interest, including investments, estate planning, family dynamics, and art. The study of wealthy Americans looks at individuals that have wealth of $3 million or more. So a substantially wealthier group. So looking up market. So I invite you to connect with Bill and Michael and me on LinkedIn. I have just posted for folks that are specifically interested in wealthy people and how they approach their giving as opposed to affluent people. I just posted an infographic with 2 pages of the top findings from the study of wealthy Americans on that topic. So feel free to connect there and see that information. And I think that is, hi Seth, love seeing that. Seth, Chalet, he's got great research on his LinkedIn as well. So thank you for that. And I think that's everything. Amy, have I missed anything in the Q&A in the that you're seeing?
No, and if more questions come through, we can always pass them along to you as well.
That sounds great. Well, you are in wonderful hands with Michael and Bill. I've got to drop, but thank you so much to the Moss Adams team for this invitation. It's an honor to be part of this very important conversation.
All right, thank you, Dianne.
Bye-bye.
Okay, it's Michael Strauss here. I serve as the investment strategist, economist for the Endowment Foundation Group at Bank America. That encompasses roughly 75 billion in assets. My bio goes through some of my history, and what I'm here to talk to you a little bit about is to explain what is going on in the economy and the capital markets, and also taking a look at things to prepare for the future. And on the sort of answer to the question, preparing for the next decade, think about AI, think about AI 2.0. It's not about who can produce the fastest chip. It's about what companies, what industries, what consumer groups can take advantage of improving productivity. And a big thing that we believe is unfolding, and we're at the beginnings of it today, is we are seeing a technology enhancement that is boosting productivity. That boosting in productivity is needed given population demographic changes, not just here in the US, but around the world. But it's also going to be the answer to the equation of how do you get better economic growth with modest inflation or lower inflation than the market fears, and better earnings and profitability. And we've already started to see some of this creep into the equation. For the better part of the last 3 years, GDP growth has come in better than economists have anticipated. Frankly, economists did a pretty bad job forecasting the economy the last year and a half, with most anticipating that we would get an economic downturn or a test of an economic downturn, and very few talking about the potential of a mini repeat of 95, 96, when we got a soft landing or a test of an economic cycle that was more of a quick touchdown and quick takeoff to moderate economic growth. This morning, we received a GDP report for the third quarter of this year. Growth came in at around 2.75%. Inflation came in at around 2.5%, actually a little lower than that. And that's a picture that's a very positive one for what's been unfolding in the economy, not just the last quarter, but for the better part of the last 2 to 3 years. Unfortunately, the political environment we're in, we're getting a lot of misinformation, but the data has clearly shown moderate growth with a little bit less employment growth associated with it, producing better productivity, better profitability, better earnings where consumers are earning more than inflation, making up for some of the lost ground of a couple of years ago. And we think this is a very favorable setup once we get past whatever indigestion we're going to get associated with the election. But when we look back at the last 100 years, and we're not going to focus a lot on the election, but we are going to focus a little bit on the facts of how markets react in elections. If we look back over the last close to 100 years, election years have typically been strong positive returns for equities, north of the average of 9 to 10%. And sure enough, this year, right now, we're running a little bit north of 20% for equity market returns for this year. Domestically driven, which is normally what happens during election years. But what's interesting is we're seeing moderate growth, moderating inflation, a situation where the Fed can begin to cut rates because inflation is well below their fears. And the Fed funds rate, which is the Fed's basic lending rate, is in a very restrictive stance when the Fed could really have it in a more neutral position. And I'll explain what some of that is. But when we look at the backdrop at the beginning of the fourth quarter, we see an economy that's beginning to show some signs of a broadening in corporate earnings. It's not there yet, but it's moving there. That will help a broader base of companies and equities to participate in gains. It may eventually lead to some trimming in the mega cap stocks, and we've seen some signs that's occurred a little bit. But we believe we're in the early innings of that process. We are clearly seeing a cooling of inflation. This morning, a great example of it, the personal consumption deflator, which is a very important inflation reading on products we actually buy, moderated to about 1.5%. And even if we excluded food and energy, it came in at close to 2.25%, a little bit less than that, 2.2%. And that's well within striking range of the Fed's target. I think the Fed is very comfortable seeing inflation with a 2 handle, whether it's low 2s, mid to upper 2s. All of those are a sign of success and a sign that the Fed can gradually ease some of the restrictiveness of the current short rate positioning in the Fed funds rate. They moved quite aggressively in September, they'll probably move in a more modest fashion. It might not necessarily be at every FOMC meeting or policy meeting over the next year, but over the span of the next 12 months or so, we anticipate 5, maybe 6 easing moves, and the Fed funds rate getting down towards a 3 3/4, 4% handle, maybe a little bit lower than that by year end next year. And that's a condition that should help to foster the continuation of moderate growth and the continuation and actually the building of a broader base of corporate profits. Are we worried about geopolitical risk? Yes, but we think that's a short-term event, and to the extent we get dislocations, it might offer opportunities to rebalance and reinvest. And we do think we're going to see a more selective consumer, but a consumer that generally is benefiting from the fact that job growth, while it's moderating, is still positive. Income growth is exceeding inflation. That's a positive. And consumer wealth is at all-time record levels in the U.S. It is somewhat bifurcated. I would like to see it broader based, but bifurcated wealth increases is better than no wealth increases. And we are seeing a situation where the salary increase, the wage increases are much more skewed to middle income, lower income individuals. And that is actually helping to foster a little bit better benefit on the side of a broader base of consumers than what we would normally get in this cycle. As far as interest rates, we are expecting and we're actually seeing a normalization of interest rates, which means rates in the front end go down, in part because the Fed is cutting rates, but they might not necessarily go down. They might actually go up in the longer end. Why? Democrats and Republicans are somewhat unified in not really doing a lot to get us on a better budget deficit trajectory. And if anything, the risk is it'll be worse under Republicans than under Democrats, but I'll save that for a little later in the presentation. What are some big points of our outlook here? Look at the yellow highlighted events. We do think we're getting a moderate economic expansion, 2 to 3%, and it's probably closer to 3 now than 2. The Fed has begun the normalization process. Financial conditions are fairly friendly. The yield curve's normalizing. The long-term bull market in equities is generally continuing. We've been favoring an overweight to equities, an underweight to fixed income, an overweight to U.S. equities, an underweight to non-U.S. equities. That's been our call for more than a year, and it's been the right call. It continues to be our call, but where we anticipate things to sort of change a little bit is on the margins, where it may be less of a large cap dominating improvement in equities, but it should broaden out to small cap and mid cap, particularly as interest rates start to move lower. If we look at the next chart here, some positive developments. The Citigroup Economic Surprise Index, the red line, is positive surprises on the economy are actually improving. That explains an economy growing closer to 3%. At the same time, financial conditions are becoming a little bit easier, in part driven by the Fed cutting rates. That's a good environment for risk assets. It's a good environment for the economy. And it probably is a good sign for things like consumer and even business confidence. The next page shows the moderation in inflation. And we had a peak in October of 22 at around 7%. It's come down to, depending on what inflation measure you're using, anywhere from about 2% to about 3% in change. And actually on a short run basis, it's doing a little bit better than that. And that's a good part of the equation. It will allow the Fed the opportunity to continue to adjust rates because inflation is coming in closer to their long-range target. When we look at what produces better earnings for the economy, it's an economy that grows at around 6 to 8 or 5 to 8% in nominal terms. And that's basically where we've been moving towards. We're right now a little bit towards the lower end of that process, but that's largely with inflation lower, coming in below 3%. And that is a process that typically helps to produce better earnings growth. We think as we move into next year, we do have the potential of getting back into double digits as opposed to single digits today. And on balance, we're encouraged by the fact that on most quarters, including the current quarter, actual earnings have exceeded analyst estimates, mainly because of things like productivity improvement and controls over things like unit labor costs. When we look at debt loads, we're encouraged. Consumer debt loads are right at the midpoint of the last 40 years. That's the red line. Mortgage debt servicing, it's a little bit higher than it was when we had 2 to 3% mortgage rates a couple of years back, but it still is in very respectable shape when we look at where it's been over the last 40 years. And that lessens some of the challenges for consumers. This next chart on public debt is problematic. The public debt is about 100% of GDP today. That's one of the reasons why the bond market has started to sell off. If no policy changes are made, it gets to 120%. If Harris's policy changes are made, it gets to 125. If Trump's policy changes are made, it's projected, and all of this is by a bipartisan group in Washington, it's projected to 145. The added challenge with Trump here, Trump does know how to issue debt, and occasionally he pays it back. But we all know the history of there are several times where he's chosen not to pay it back and declare bankruptcy. And that may also be something that's weighing on the bond market. Not that the federal government is going to fail to pay its obligations, but that if we get a change in Washington, we may get a lot more risk with the government's balance sheet, which could be challenging for the back end of the Treasury market. And in fact, if someone were to say, what's your wild card risk? It's that debt becomes an issue, and we need a return of the bond vigilantes of the late 80s to sort of get fiscal discipline back into the equation. And for those that weren't around in the late 80s, what happened then is Republicans agreed to tax increases and Democrats agreed to social spending cuts. And we actually got an agreement that helped to improve the trajectory of our debt and finances of the federal government. We're unfortunately a long way from seeing return from that, but maybe some hope that the bond market will help to spur a little bit of a reawakening. On a positive note, inflation in the developed world, US, Europe, and Japan, we're all seeing inflation rates come down. And this is even with the indigestion that's occurring in energy prices from time to time because of the events in the Middle East. A common question I get asked is, why haven't we had a bigger effect on oil prices from the Middle East? Part of the reason is the U.S. is now producing 13 million barrels of oil a day. That's double from what we produced 10 years ago. And that increase is more than the production that we get from a lot of the bad, most challenged countries in the Middle East. That's one part of the equation. The second part of the equation, who else needs some version of peace and some ways to weaken Iran, Iraq, and some of the bad eggs in the Middle East? The answer to that is Saudi Arabia. How can they fight that battle? By producing more oil, and they're the country with excess capacity in the Middle East. So that's just as an observation, not as a forecast. When we look at equity market returns here, on the right-hand side, we see the S&P performance after the Fed cuts rates. When the Fed cuts rates within 1% of an index high, that's happened 12 times in the last 40 years. Every one of those times, a year later, the equity market's been higher. On average, that increase is about 15, 16% versus the average historical yearly performance for the S&P of about 9, 10% over the last 100 years. We go to the next page here and we look at what valuations looked attractive to us. On the top left, we see a blue line that shows small cap versus large cap. Small cap relative to large cap looks cheap, or large cap relative to small cap looks expensive. We've seen some bounce recently, but still a long way to go to equilibrium. And maybe we don't fully go to equilibrium, but where is the better opportunity set developing? It's developing in small cap, and the line below it in red in value versus growth. When we look at the right-hand side chart here, we look at how small caps have historically performed against large caps. And if we focus on 12 months out after the first rate cut, typically small caps do about 2 percentage points better than large caps. We think that a number of these charts imply historically that once the Fed continues this easing process, and they're likely to continue it at a smaller pace and a less frequent pace maybe, that still supports small cap companies. Why? Because they're the most sensitive to the positive benefits of lower interest rates. The next chart shows equal weighted stocks against large cap stocks. And again, we see some opportunity in equal weighted or a broader market basket of stocks. And if we turn to the next page and we simply look at the boxed area on the right, this shows that actually we've started a little bit of a rotation away from the mega cap stocks into a broader segment of the remaining S&P 490 or 475 stocks. Is it a light switch that turns on and it goes all the way in that direction? No, but it probably suggests as we move into next year, we'll see a broadening out of market returns. And that's a situation that will enhance portfolios that are focused on stock picking rather than index positioning. When we look at dividends, a similar story exists. Dividend aristocrats are companies that have paid dividends and increased dividends over a broad number of years. And again, if we look at the bar chart on the right and we look at the average dividend stock after the first rate cut, 1, 2, and 3 years later against the S&P, that market basket of stocks that have dividends, support the dividends, continue to show dividends, have earnings that exceed the dividends, typically outperform the generic S&P index. And we would expect that to be something that unfolds over the coming 1 to 3 years. The page here on the right, highlights some of our main issues, the upside risk factors, and some of the more challenging ones. Obviously, on the challenging side, the geopolitical issues, both domestically and internationally, are at the top of the list. For China, they finally get that they need to provide stimulus, but the stimulus they've provided so far, while it appears to be big, is just the tip of the iceberg that they need to do to turn their economy. And clearly, one of the few things Democrats and Republicans agree on is a fair amount of China bashing and the potential of tariffs, which is also going to challenge their economy. So where does this lead us? We still like domestic-oriented equities. We still favor a position there. And as we'll show on the next chart, what would get us a little bit more excited about non-U.S. equities? We'd probably need to see some movement in the dollar that sustains some weakness. Right now, we've gotten some testing of the waters, but not sustainability on that. I want to be respectful of time and turn it over to Bill. And after Bill talks, we'll take some questions you might have.
Good afternoon, everybody. In the minutes that we have, we're going to first start with some polling questions. Amy, you can pull this up. You're all private foundations. We just want to know a little bit about you. Take a look at these various roles and tell us who you are.
All right, everyone, make sure that you're hitting the submit button. This has quite a few response options, so you may need to scroll down to see that submit button on your slide. And we do have a couple more polls coming up back to back, so just be paying attention here.
Okay, so most of you by far are staff. You're not necessarily in programs or development. Development doesn't really matter for private foundations. And we have some founders, some executive directors. Let's go on to the next poll, Amy. Endowment size, because we're going to talk about endowments in a minute.
All right, it looks like most have submitted. I'll leave it up a few more seconds here.
Mm-hmm. Gradually chunking in there.
All right, here are the results for this one.
Okay, we have some quite large foundations, about a quarter of you. And then, as one would expect, a fairly large number under 100, under 300 million. So quite a variety here. And we have one more polling question, your annual spending rate. And of course, you are a private foundation, less than 5% might apply for this year if you were overspending in previous years. So I'm just interested in whether you're taking advantage of the averaging or whether you're doing 5, 6, more than 6, what's going on there?
All right, I will close this one out here. Make sure that you hit that submit button. And here are the results.
Okay, so some of you are making up with this less than 5. You were overspending, perhaps into the social issues of the 2020s, 2022 period. About half of you at 5%. Some of you overspending into 6. Some of you about 10%, 11%. Doing more than 6, and then some of you are presumably corporate foundations that are just doing a pass-through. So what we're going to do here is talk about a study that I created and edited in my previous career. I've been doing this research work for about 20 years now, and when I was at the Common Fund as the executive director of their in-house think tank, the Common Fund Institute, I created and got the partnership with the Council on Foundations to do this private foundations and community foundation study. This is the private foundation slice we still have good relations. And so I'm going to give you a sense of what's going on here. This is a study that is undertaken by my previous colleagues at the Common Fund Institute. You've got nearly 300 private and community foundations participating, of which 182 are private foundations, 126 billion in private foundation assets represented. So let's take a look at what's going on here. This slide here shows the annual net returns for the private foundations in this study for every year since 2014, the last 10 years up until 2023. This is as of December 31st, 2023. And you'll see there's just huge volatility here. This doesn't look like a finance textbook. This is the world we live in. Up double digits, down single digits, some cases down double digits there. But over the 10-year average, it's 7.1%. I want you to hold that number in your mind, 7.1%, because we're going to go now and take a look at what the average net return was by size. So here we have the red bar is those that are over 500 million. You can see there's some of you here on the call. The 101 to 500 is the navy blue bar. The gray bar is the under 101 million. And if you look in the annual net total return, you can see because of 2023's very strong, Michael mentioned this, performance by the tech stocks, right? That Magnificent Seven that you keep hearing about. That meant that smaller foundations, which tend to be less well diversified in their portfolios, had in that single year higher returns. But if you look out at the 3, 5, and particularly the 10 years, you're looking at higher returns by what? The over 500 millions. And we'll see how they're diversified and what that practice is. Some of it may be access to managers. Some of it may be investment committee expertise. But a lot of it is going to be, I would propose, asset allocation that leads to these longer term returns. And when we're thinking about returns, remember that in this private foundation world, you're spending at least 5%, and we see some of you are spending more. You also want to keep pace with inflation in the form of the consumer price index, or maybe even the higher education price index, which is a good proxy for nonprofit inflation measures. I calculated that as well in my previous work. And then we put in costs, but let's net those out. So remember I told you that 7.1 was the 10-year return for this group of foundations. Here's 8.0. Take the costs out, net it, that's 7.0. So this group of foundations taken as a whole is actually doing a pretty good job of maintaining that 10-year outlook in terms of performance. But if we go back here, you can see these smaller foundations are barely scraping it, 6.8, 6.6. That average is being created by these larger foundations with, as we'll see, a completely different asset allocation. Now, this asset allocation pie is for all the foundations in the study, and it's dollar weighted, so it shows what the larger foundations are doing as well. As we go around the clock, this very pale blue sort of 1 or 2 o'clock slice of 25% is the US equity piece. Then going clockwise around, you've got the fixed income piece at 12%, the non-US equity piece at 14%, and this big sky blue slice of alternatives. This is very like what colleges and universities do, except foundations are a little cashier. Foundations are a little more liquid. Why? Because you need to make cash grants. In the foundation world, it's 46% alternatives. In the higher education world, believe it or not, from the NACUBO study, National Association of College and University Business Officers study, which I also edited for many years, it's 56% in alternatives. And when we break this down by slice, you'll see again, largely driven by these big over 500 million institutions, the 101 to 5s, the 101, really quite similar in their asset allocations. Again, taking the sky blue slice, that's that very pale blue US equities, then fixed income, then the navy blue or a sort of more darker blue non-US, and that very dark blue slice is the alternatives. So what's in this alternative slice? You can see it itself is diversified. If we look at the 53% of alternative strategies, it's quite mature at this over 500 million group. It consists going around clockwise again, that sort of maroon area, that private equity, then a slice of private real estate, private credit, excuse me, then marketable alternatives, which is hedge funds, venture capital, very mature portfolios at 16% of the portfolio, private real estate at 4%, energy natural resources at 3%, some commodities, managed futures, and distressed debt. And as you go down in size, you see the same diversification. It's just not the same percentages. And so this is a very good, interesting way of looking at this and showing, okay, on a one-year basis, as Michael said, you've got these market enthusiasms, which are pushing the liquid stocks up. But over time, this diversification is what really matters in terms of getting those long-term returns up above that 7.1%, that 7.1% that we saw there. I'm just going to touch on spending policy. I know we're coming to the top of the hour, and I think we have until 5 after, but I just want to be sure we cover this. Spending policy, we know you have the minimum 5%. This is various methods that I use in all the studies that I edited. But here also we see many of you do, in fact, use a moving average. Amy says I have 15 minutes left. Thank you, Amy. I can slow down a bit. So here we have using a moving average, which is obviously subject to the IRS minimum of 5%. For those of you that have multi-year programs or multi-year grant relationships, this is going to be very important, using a moving average. Some of you on the smaller side probably are just deciding on an appropriate rate each year, although as I see, here's an over 500 million, about a third of you decide on an appropriate rate each year. There's no smoothing going on there. But it's an important consideration. You do have some choices in spending, not just the regular 5%. Finally, I'd like to take a look here at the composition of the investment committee. The committee, obviously, the group that oversees, and in the private foundation world, unlike the community foundation world, investment committees tend to be rather small. You're looking at 5 to 7 people here. And so what we see here is the qualifications, if you will, of the investment committee. The red bar is the average number of members on the committee. You can see your smaller institutions, your smaller foundations at 4 to 5 members, probably the founding members of the family, plus a counselor or two. And as you get up higher, you begin to get a little more institutional, even though it might be a private foundation. We're looking for people who are investment professionals in this second category here. They tend to be about somewhat less than half of the group in the smaller ranges. Again, somewhat more than half in the larger area. And then who has alternative strategies expertise? Well, of course, if you're going to lean into those alternative strategies in your portfolio, you're going to want to have that capability for sure in your committee. And so there you see this group of 3.1, considerably higher than the others. This is just an overview of the study. I've sort of raced through it because I felt that we were under a little bit of time pressure, but it does raise questions. And here are some questions that we could ask. How the returns of your foundation's endowment compare with those of your peers and why? What are you doing, particularly in asset allocation, the decisions you've made that lead to results short, medium, and long term? What's your attitude toward including alternative investment strategies in the portfolio? How important is liquidity? As we know, foundations, you need to make those cash grants out. And so having that cash available is important. And then as Michael referred to, how has your portfolio been affected by the Federal Reserve rates actions with respect to interest rates and inflation? And then a topic that we didn't really touch on here, for some of you, responsible investing, that is to say, reflecting your values in the portfolio may in fact be something that's important to you. So I'm going to pause here. We'll end it in about 3 minutes. I'd see if there are any questions. Amy, you've got us ending in 3 minutes, and I just want to be sure that we have time for any questions or wrap up before we say thank you and give on to the next session.
I am not seeing any additional questions from what we had from earlier, but if the audience does submit some, we can pass them along to you after this session. Okay.
All right. Well, thank you very much, all of you, for allowing us into your meeting here. We obviously can see the names here. It's an illustrious group of grant makers. We honor your function. And as Dianne began, we are in this business. We are the largest manager of foundation assets in the country, and always happy to be at your service. So you know where to find us, and we're happy to discuss this or any of the other topics further. Thank you.
Yes, thank you.
Yes, thank you so much, Dianne, Michael, and Bill. That was, incredibly insightful. I know our viewers will take a lot away from today's information. We really appreciate everyone's participation today, and I'm going to pass it over to Amy to give us some logistics regarding the break.
All right, thank you for a great discussion, everyone. And yes, we are going to take a quick break and then regroup for our next session, which is making an impact through policy, key considerations. Please keep your webcast console open and then join us back here in about 15 minutes. So we'll kick off here at 11:20 Pacific time. Thank you.
Welcome back. We're going to go ahead and get started again. I hope everyone enjoyed that quick break and our first session that we've had already. In the interest of time, we're going to move right into our second session on today's agenda, Making an Impact Through Policy, Key Considerations. This session will delve into the specifics of advocacy, lobbying, and political expenses, as well as understanding which expenses are allowable and how to accurately report them. Joining us today are Saskia de Boer, partner with Stoel Rives, and Maggie Elliott, Moss Adams Tax Senior Manager. With that, I'll go ahead and turn it over to Saskia and Maggie.
Thank you, Wendy. So today on the agenda, as Wendy already alluded, we're going to talk about election year issues, political campaign activity, lobbying, advocacy, and how it really relates to public charities, private foundation, as well as other 501c3s. And with that, Amy, we have our first polling questions to gauge who's in our audience today. So what kind of tax-exempt organization are you? A, 501c3 private foundation, B, 501c3 public charity, C, 501c4 organization, or other. And it looks like we have a good participation today.
All right, I'll close this one out here shortly. I do want to remind the attendees that this session, you will need to respond to at least 3 of the 4 polling questions. All right, here are the results. Yeah, and hit submit.
Okay, great. As expected, a majority of our audience is private foundations. There's a good attendance of public charities, but interestingly, small amount of C4s and others are 22%. So that's good to know. And that's essentially, as I mentioned, what we expected. And so election year issues. The lobbying rules for charitable organizations, especially those described in the 501c3 IRC Code of 1986, which was amended, and a lot of the rules in tax law currently do stem from that 1986 tax reform. But they do differ for public charities and private foundations, as you could see here. So generally, 501c organizations can educate the public about issues, engaged in nonpartisan voter activities without restrictions, and for public charities, perform lobbying activities within certain limits. While public charities may conduct a limited amount of lobbying, private foundations are prohibited from making lobbying expenditures and also earmarking any funds for lobbying purposes. Section 501c4s are subject to fewer restrictions around lobbying and our legislative and political activities, and they can engage in lobbying or funding lobbying efforts really to an unlimited extent. Of course, so long as their lobbying furthers an exempt purpose for which they're organized for. At the very bottom, important reminder, what Saskia and I are going to be talking today about and sharing our opinions on really revolves around the federal tax law. But there's, of course, the state level and local level campaigns. And I will admit I am not very politically well educated. So once you get down to the local level, I think there's a lot of nuances and a lot of interesting things to pay attention to, and a lot to pay attention to. I don't know how you feel, Saskia, on that matter.
Absolutely. So I think that it's important to really pay attention to those other types of regulations, which could have additional reporting requirements and some restrictions as well. So what we're going to talk about here is that federal tax law, like what Maggie said. and really delving into the distinctions across those different types of C3s and C4, and then the distinctions between political campaign activity and lobbying versus advocacy as well. So the entity type, and then whether it's campaign activity or lobbying will be our focus here. So on the political campaign activity, what is political campaign activity? I think for anyone turning on their TV or radio now, they would say, what is it not? We're in the middle of an election year with all kinds of activity that's happening here. I think, we'll start with what is political activity as it relates to not your TV, but as it relates to what it matters for our 501c organizations. And political activity here is an activity that supports or opposes a candidate for public office. And so in looking at this, oh, I'm seeing you can barely hear me on the comments, and I'm not sure what the problem is, but I will see if I can lean in a little bit and hope that helps. So starting with this, the campaign activity, who is a candidate for public office? That's where you have to start if the definition is an activity that supports or opposes a candidate for public office. So really looking in the life cycle of a campaign for a candidate, you can see from that bottom bullet point, an incumbent who's presumed to run again is a candidate for office, somebody who's announced their candidacy, and somebody who's officially registered as a candidate. And the candidate definition here is actually a different group of people than what we'll be talking about in the lobbying space. So here it's candidates for all types of offices, U.S. Congress, city councils, local school boards, and even elected judicial positions. So all of those for this purpose come under the definition of a candidate for a public office. And so it's important for this to note that it does include some folks beyond legislators, which is who we'll talk about on the lobbying side. And so that is for the beginning of this definition, who is the candidate for public office. Then Maggie, if you want to go on to the next slide, we'll talk about what the activities are that you can or cannot do to support or oppose a candidate for public office. So on this one thing, as Maggie noted at the beginning, remember that the rules for all 501cs here are the same. That 501c organizations cannot engage in political activity. And so that's a good point here for private foundations and public charities. Oftentimes, private foundations are trying to understand what it is that they can do, which is different from their charity grantees in the lobbying space. This is one of those places where C3s have the same rules. So we know that we are almost at the end of this election season, but it's important to know that what it is that you can do during election season and what you can do in political campaign activity. And so we like to always note that just because you work at a nonprofit, at a 501c3, it doesn't restrict what you can do on your own time with your own personal resources in the evenings and the weekend. And so that is something that is a way that you can be involved in our democratic process on your own time. But you can't do what you could do on your own time on your work time and with your work email and with your work meeting space and work with your work title. So what 501c3s can do is during the election year, provide your views on what issues you're working on to all candidates. You can post things on your website. You can make things available as long as it's available to all candidates. And again, that's because what you cannot do is try to slant your information or do anything that would express or impliedly endorse or favor one candidate or the other. And so what I find a lot of organizations aim to do is post information on websites, distribute it to all registered candidates, and if somebody asks, you can provide something to a candidate that's already been posted on your website or has already been drafted. What you can't do is offer candidates access to your meeting space, your office space, anything that would relieve them of some other type of expense or do any sort of support to that candidate. You also can't coordinate your activities with different political parties or campaigns, or do something that is timed in such a way that it would really help or hurt one candidate in particular. Noting again that we're at almost the end of the election season, one thing that you can do as well is send a get out the vote social media post. And that is something that you could do in the next week. You can't say anything that would be get out the vote to lean toward one candidate or party or the other, but you can encourage people to find where they can vote and encourage them to vote. Maggie, what more do you have to add on the cans and can'ts?
I think you summarized that very well. I think the one important reminder is that, for those tuning in, it's important to understand the rules, but also important to educate your employees, your board members, and everyone at your organization so everyone is clear on these rules, because you could really slip up, and have someone who doesn't intend to break the rules, use the copier machine, which, could be unfortunate. So I think education internally and understanding and keeping up to date is important.
So I think on this is an ongoing, theme of what we were talking about earlier, and to make sure what Maggie just said, that staff and board know that of what they can do on their own time, their own personal political activity, but also to be informed about what it is that they cannot do when they're either wearing their board hat, board email, or using the organization's resources. And so again,
Sorry, I was going to add that that's, another good reminder for those that are active in their communities, right? A lot of your organizations have big impacts, and there may be, little distinction of your persona as as the CEO or president of an organization, and when you're representing that organization and when you're representing yourself personally. So I think whenever you're speaking or making comments, I think, and you're not, in your or wearing your organization hat, it's important to state that, you're speaking on your personal behalf and this is your opinion. You're in no way associated with the organization, because I think even when you're not breaking the rules, in another setting, I think it could be construed as an opinion coming from somewhere else. So the direct and indirect.
That's a great point, Maggie. And I think one person has shared with me, always when you're on your iPhone and you're toggling between different email addresses, this is a time to be careful that you're toggling over to that personal email address as well. Thinking of those different hats and keeping that separation there.
Yeah, and that's actually a great reminder, Saskia. I've heard a story where someone inadvertently used, actually got an email from someone else to their work email, and their response was, responded to that email and said, this is my, work email. Please do not email me at this address. This is another address you could reach me at on this matter. So I think that's appropriate, even to immediately stop those kind of communications that might not be even coming from you, but coming to you.
That's a great point. I think, and all of this, this has all been about the 501c3s, right? And the political campaign activity. And so to just kind of go full circle back to how Maggie teed us up, the political campaign activity prohibition is the 501c3s. It's not to 501c4s. So 501c4s can engage in political activity, and we'll talk about that a bit later. But we wanted to tee this up about what is the political activity, and we talked about what it is and what it is not, because of the that C3s can do none of it, but C4s again can. so we'll get back to what C4s can do here in a bit, but that was the C3 political campaign activity intro. So I think now we're going to switch over to lobbying. There are two words I think that come up and that I use the most, at least in talking about lobbying, and that's lobbying and advocacy. Really how lobbying is defined in my mind to say what is lobbying, and advocacy is everything else. And so for those 55% of you, I think it was, who are private foundations, I think about, yes, the lobbying is defined as what you cannot do, but if it doesn't fit within the definition of what lobbying is, then it's advocacy and it is something you can do. What we're going to be talking about here is what is lobbying, so that you can be on the lookout to know, if you're a private foundation, how to structure something to make sure it's not lobbying, and if you're a public charity, to be able to monitor it for appropriate reporting as well. So I, as a child of the 70s and early 80s, think of lobbying as Schoolhouse Rock. I think back to that, about how a bill becomes a law, and I think of a little bouncing bill moving along on the steps, and what that is. And it really is, in this visual for me, is the pathway to how something becomes law. And so, two different pathways from Schoolhouse Rocks and from how we operate, of either going through legislative bodies or through ballot measures or initiatives, or whatever your state may call that mechanism for citizens to stand in the role of an elected official. And so for purposes of lobbying, we're really talking about those pathways to implement law, either through legislative bodies or through ballot measures and initiatives. And as Maggie laid us out at the beginning, charities can do some lobbying, private foundations can do no lobbying. But again, as I noted, advocacy, being something that is not lobbying, can do unlimited advocacy for all. So this one is something that is a kind of a flow chart that for me is how I think about doing an analysis of whether or not something comes under the definition of lobbying. And so, like we did when we were talking about the political campaign activities and starting to understand at first who is an elected official, and then what is that activity that could be influencing something about the election of activity. Here, we need to understand what the components are to make something lobbying, so that we know whether or not it's lobbying or not. And so there are two types of lobbying in the Internal Revenue Code: direct lobbying and grassroots lobbying. And so when I'm going through the evaluation process to think about whether some sort of communication is lobbying, I go through these questions that are up on the screen, and I always start with, who is the audience of this communication? And so I'm again trying to understand if a communication is lobbying or not. I first start to look at who is the audience. And so when I'm thinking of audience, I'm thinking of, it could be somebody who's on the to line of an email. It could be the person who's on the other side of the phone call from me. It could be a recipient of a press release. It could be somebody I invited to an event, right? But who are these people, and what is this audience for this communication? If that audience is somebody who is an elected legislator or a member of their staff, then I am concerned with whether or not this is direct lobbying. And that's where I first start. So who is my audience in my communication? If it's an elected member or their staff, then I'm going to look at this direct lobbying component. Now note that I said elected legislator or staff, That doesn't include the other branches of government, so the executive branch, the administrative branch, the judicial branch, unless they're involved in drafting legislation. So it's the elected legislator, their staff. It could involve some others if they're involved in drafting legislation, but the main piece is that as the audience. So that is the first prong for direct lobbying, is the audience that. Then we move on to the content and the message. So if the message and the content of that message refers to pending legislation or to a specific legislative proposal, and if it expresses a view on it, then it is a direct lobbying communication. And so again, starting with who is the audience, then looking at the content of the message, that is how we decide if something is direct lobbying. So note that the content in referring to a specific, to pending legislation or a specific legislative proposal, that proposal is because we recognize that something doesn't have to be, hey, Senator Smith, vote yes on Senate Bill 6, because maybe it's not yet introduced to Senate Bill 6, but we know that the senator is working on it and working on crafting it. And we know in this life cycle of drafting legislation, there's opportunity to make impact, and that still counts in that proposal land. So, when we're looking at this content for what is included in specific legislation, it can be any act of Congress, a local council, a state legislature, or some other similar legislative body. So it would be something, again, that those elected legislators would vote on and pass. And so that is the content of the message. The expressing a view, like I said, could be something like vote yes on Senate Bill 6. It could be something like saying, hey, that's a great idea, or that would really benefit our state. So somehow having some sort of a view on this proposal or legislation, that all together really makes up what the direct lobbying is. And so those are the components for the direct lobbying. The grassroots lobbying has an audience of anybody else. So that when we're figuring out who's on the other side of the to line, the invitation, that's anyone. It's the general public. To be grassroots lobbying, though, you have the components I just talked about with the content of the message referring to a specific legislative proposal or legislation and expressing a view on it. But there's one additional element here, and that's a call to action. And so that's important because while you couldn't say to Senator Smith that Senate Bill 6 is a great idea, you could say to the general public that Senate Bill 6 is a great idea without it being lobbying. What you couldn't say, and what would make it grassroots lobbying, would be if you said, hey, general public, Senate Bill 6 is a great idea and you should call Senator Smith and tell him to vote for it. And so that's that extra element in the grassroots lobbying components that does not exist in the direct lobbying components. So that's really the flow of how we think through whether or not something is direct lobbying or grassroots lobbying by looking at the audience of who the communication is going to and looking at the content of the message, what it may be referring to, whether or not it's expressing a view on it, and if grassroots lobbying, whether or not it has that call to action. Maggie, do you have more things to add there?
I don't. That was very well summarized, Saskia, and I think we'll get Amy to set up the next polling question. So how would you rate your organization's engagement in policy now that we talked through some of these items? Just curious. A, is it part of your strategy? B, not engaged at all but interested? C, are you newly engaged? Or D, other? All right, here are the results. 30% said it's part of their key strategy, 24% are interested, 9% are newly engaged. So we have a quite engaged audience here today with us. That's great. And we'll move on to the 3 named exceptions, Saskia.
Great. So the Internal Revenue Code says, okay, Saskia, you just told us what all the elements are for figuring out if something is direct lobbying or grassroots lobbying, but we're going to name actually 3 specific exceptions. Those exceptions, the first one is saying, but not lobbying is discussing general policy, talking about outcomes, talking about data. I actually feel like this isn't really an exception to what I just said. It's more an affirmation of you can talk with legislators, you can talk about things like outcomes and data. There's nothing in here that says I'm talking about a specific legislative proposal, but it is an explicit thing saying you can talk about general policy discussions. This next one about a legislative committee's request for technical assistance and expertise is something that I have found that is a great tool, especially for private foundations to be able to use. And that is that if a legislative committee sends a written request on behalf of the committee to the foundation and says, could you provide some, we're working on this topic, you're an expert in this area, could you provide some additional information, whether it be written or testimony or what it may be? And if that's the case, then that really relieves a private foundation from the lobbying definition, in that it can provide information that can also have an opinion that's baked in. I want to be clear that this is a specific exception, that the request has to be in writing, it has to be from the chair, and the distribution and the sharing of the information has to be to the full committee. So this is not a sidebar conversation with one member of a committee or with one legislator. It is an entire communication to a legislative committee. Now, a lot of state legislators don't know, of course, about these rules, about what lobbying is and how different private foundations can help. And a lot of private foundations have now realized this is a great opportunity to talk to legislative chairs and explain to them how they can be of help in providing additional information. And private foundations can actually even say, hey, legislative chair, if you send us a letter that asks for this, we can provide you additional information and help educate the committee on this exception and how you're able to provide that additional information. So that may be something that's good to know about as a private foundation looking for a way to share additional information to a legislative committee. The last one is a white paper that is more than just a thought paper, but really something that has to meet the IRS's requirements about content and distribution, meaning it needs to be a thoughtful paper that is balanced in its overall analysis. It can have a conclusion at the end, but it has to be a bit Encyclopedia Britannica in the pages and leading up to any sort of conclusion, and it must be shared broadly. So this has to be something that's shared with academics, with thought partners, with journalists, not just with legislators. But that's a way to be able to say you could have an opinion that is baked into a conclusion of a white paper, and that white paper could be shared then ultimately with a legislator, and that would not come under the lobbying definition. So Maggie, those are our 3 named exceptions.
Great.
Well, and if I could insert a question really quick. So Saskia, you covered 3 exceptions, but what are ways that Section 501c3 organizations can have an impact without coming under the definition of lobbying?
Yeah. So Wendy, that's a great question, and I think that's what goes to me when I started framing this as the words of advocacy and lobbying. And so all C3s can do unlimited advocacy. And, I'm a firm believer that for foundations to really further their mission, they need to do advocacy, right? That's an important piece of their work. And so this is here, some examples, and the not lobbying side here. This is all permitted advocacy by private foundations. Of course, charities, as we said, can do some limited amount of lobbying, so they can also do some lobbying, but everything on the left, all C3s can do in this advocacy. And so going back and thinking about the definitions and the elements of audience and content, so long as something doesn't meet those prongs of audience and content, it's not lobbying. So that opens up a lot of things, right? What that means is talking with, the agency and executive branch. So there's so much that happens on the agency side that foundations can really lean in there. Something that I love are op-eds. So finding ways to get opinions out into the public, because in that case, your audience is the general public as you're thinking through our prongs. And so long as your op-ed doesn't have a call to action in it, you can express an opinion in your op-ed that's published in your newspaper, in your local newspaper, and that's advocacy. But more than that, and those examples I just gave really were pulling into the different definitions of what lobbying is. But more than that, you can absolutely share all kinds of information about your work, the impact, the outcomes that you're having, and tell your story and be a resource for members in the legislature and for decision makers across their state and across the country. You can also, as a private foundation, make grants to other organizations that do some lobbying, and that's an important thing to remember as well. Maggie, what more do you have to add about that?
I think we'll talk a little bit about the grants later. So with that, I will have Amy queue up yet another polling question to test your knowledge this time. Public charities may engage in an unlimited amount of, that's supposed to say unlimited amount of lobbying, advocacy, political campaign activity, or none of the above. And this time we're going to test if we're paying attention. All right. Good job, everybody. It looks like people have been paying attention. So yes, public charities may engage in an unlimited amount of advocacy. And that leads us to focus on the public charities and the fact that they, unlike private foundations, can do an insubstantial amount of lobbying. And the IRC section 501c3 says literally no substantial part of public charities' activities may constitute attempting to influence legislation. Of course, they're not defining anything clearly, and defining substantial, there are two tests, there's two options for complying on these limitations. I would be curious to get your thoughts, Saskia, on the percentage. Definitely the case law suggests that 5% is permissible. Over 20%, there's cases where it was deemed not permissible. What do you generally advise clients with? I definitely have heard the 5% commonly, but just curious, in practice, do you usually stick with the 5% or do you use the range?
We often, give the range as you did here, Maggie. Yeah.
That's good to know. And for those public charities in our audience, as I mentioned, you have two options for complying with the limitations, one of which is the expenditure test, or what's called the 501H election. The Section 501H of the code enables public charities, other than churches, to have lobbying activities measured by this expenditure test. And so an organization makes this election by filing Form 5768 with the IRS. It's a one-page form, and it subjects the filing organization to specific lobbying definitions and also expenditure limits based on a percentage of the organization's total operating budget. So this is a chart that sort of lays out the groundwork. And so, for example, an electing organization may spend up to 20% of its first $500,000 on lobbying, but only 25% of this amount may be used to support grassroots lobbying. And so going back to Saskia's distinctions between direct lobbying and grassroots lobbying, I think one wanted to highlight that since, even if you have a 501H election, I think paying attention to these limits, especially as they're in these two different buckets, is important. And what may not be obvious in this chart is that the larger an organization's budget is, the smaller the percentage of the budget that can be dedicated to lobbying. So an organization that has an annual operating budget of 17 million, for example, is maxed out at this 1 million of lobbying expenditures. An organization that exceeds its allowable limit must pay the excise tax, which is equal to 25% of the excess expenditures. And of course, excess expenditures over the 150% of the limit over the 4-year period on which the test is measured will result in the revocation of the tax-exempt status. So the primary benefit of the 501 election is certainty. There's definitions, organizations with very large operating budgets, as I mentioned, or where your primary focus may be grassroots activities, may decline to make the election because of these limits. So I think the one important thing to mention is that in order to comply with these requirements of the election, an organization must establish mechanisms to track its lobbying and non-lobbying expenses, and this includes staff time, as well as reasonable allocation of overhead cost. We don't have the definitions, I don't believe, but volunteer time, which may be included under the non-substantial part approach, which is no 501H election, to measuring lobbying activities not tracked under the 501H election. So volunteer time is not captured, although of course time that paid staff spend, for example, coordinating volunteer lobbying activities should be recorded as a lobbying expense. So here's a quick sort of plus or minus pros and cons is probably a better way of saying that between the two.
And Maggie, could I interject for a minute? I think you're getting to it based on this slide, but we do have a number of public charities joining our conference today, and we appreciate their attendance. For them, with regard to this 501H election, what questions do you or Saskia ask when a charitable organization is considering making that election?
That's a great point, Wendy. Sort of as I outlined, I think it's important from our end to educate on what the limits are. And for smaller and newer organizations, it makes sense to make the election for whatever reason. But I think looking further out long term, does it make sense what its planned activities are? What's the growth trajectory? Of course, I do want to mention that if you do elect under 501H, if you're not stuck forever, you could diselect. You go through the same exact process, same form filing to diselect. But I don't know, Saskia, do you have any other? I think just making sure they understand and know that there's clear guidance and more strict, clear rules that they have to stay and maneuver within versus a little bit more leeway, if you will. At least there's a lot more gray in the without the 501h election.
Yeah, I think that's right, Maggie. And I think with that, this is one of these times where I say, you know, somebody calls me and say, you know, talk to Maggie, right? And I say that because of what you noted as well about having a mechanism in place to track expenses, right? So I think really thinking through what does your process look like, what's your accounting, you know, records, and how are you tracking things, and really making sure that folks have that in mind. So I think it's a good conversation to have with a bunch of thought partners in this, from the administration and finance, you know, side to activities and programs, and looking forward and what this may look like.
Yeah, and one thing I will mention that in practice it's been interesting, because a lot of newer clients to us, we often ask about this election, and there's been definitely instances where clients say, you know, we don't know, or no, and it's one of those things that when you go to file with your 990 with the IRS, there's a certain part of Schedule C that needs to be completed that's different if you have a 501h election. And so we found out by, you know, IRS rejections sometimes that the clients do have the 501h election. So I think if you do have one, documenting it, knowing what it is about, and just, you know, having it have purpose, I think is something to think about.
And I think
with
just that
we
election, oh, I'm sorry, Maggie. I was just going to say that election becomes part of your permanent records as an organization. That was all I was going to add.
Yes, good point. And with that, we have our last polling question. Private foundations may engage in a de minimis amount of lobbying if they have a 501h election in place. True or false? And I realize that the 501h election, without giving out the answer, may not have been super interesting to necessarily our private foundation audience, but I do think it's important for private foundations to understand what the public charities rules are, and it would be very easy to look at a public charities 990 to determine if they do have the election. It kind of gives you a little bit more visibility of what those organizations do. And I think I'm setting up Saskia and I for our closing section here. Okay, so answer is false. Private foundations can't elect 501h. This is only for public charities, and does not include churches. So as I mentioned, private foundations and under Section 4945, if they do any lobbying, it's considered a taxable expenditure. And so this is defined by direct reference to the definition of lobbying for electing public charities under the regulations. Oh.
I had another question real quick before we shift to C4, 5, and 6s. Can a private foundation make a grant to a public charity organization that lobbies, and what cautions would you have if they can?
That's a great question.
Yeah, so it's a great question. So I think the answer is absolutely yes, that private foundations can make grants to charities that lobby. And whether or not the charity has made the 501h election or not is not part of the calculation. It's good for you to know that, but that's not part of what the private foundation should be concerned with. The private foundation can always make a general operating grant to a 501c3 public charity, and that 501c3 public charity can be a charity that lobbies. So, you know, general operating grants are always a great approach for private foundations to support charities. Foundations can also make private project grants to charities for projects that involve some element of lobbying. That requires some more due diligence on behalf of the private foundation. So for that, the private foundation needs to request a copy of the budget for the project from the charity, and verify that the expenses that are not lobbying expenses of the project are more than the amount of the project grant that the foundation would make. And so that's that extra due diligence that foundation would need to do to make that kind of grant. But general operating grants to charities, always project grants that involve lobbying, that cannot be earmarked, of course, is the rule for anything to do with lobbying. But that's how we deal with it, by looking through the project grant budget. And also private foundations, of course, can always make expenditure responsibility grants to other types of organizations as well. And for that, then it has all of the expenditure responsibility requirements for monitoring how those dollars are used. So those are the different kind of buckets. Maggie, what more thoughts do you have on how foundations can support organizations that are involved in this?
I think you summarized that very well, and it's the grant question comes up often, and you always want to say yes, but quickly, just to make sure that they really do their due diligence, and especially for some of these smaller organizations, a small private foundation grant could be a very, very large grant for a smaller public charity, for example. And so I do want to remind folks that under Section 4945, the taxes are imposed if you were to do any lobbying on both the foundation and any foundation manager that knowingly and willfully agreed to those expenditures, and the initial tax is 20%. So just wanted to mention that. I know private foundation law is stricken with rules and these penalties, so just wanted to throw that out. As we kind of transition to our tail end of conversation today, and the 501c4s and other entities. And so I don't know about you, Saskia, but I think there's just been a lot more 501c4s and a lot more questions about 501c4s. I get a lot of questions from private foundation clients about 501c4s and creating ones, which I think, going back to our initial and very first slide, I think the differences in the code and the different types of organizations and what they can and cannot do, everyone should kind of stay in their lane. But I think for those private foundations that want to have a C4, it's important to make sure that those, as you just saw in our discussion today, that you're not allowed to lobby. So in no way, would you would really want to have an organization that had a completely distinct board, and that, you also looked at the granting, right, that we just talked about. But in general, I think 501c4s became attractive, and it's sort of been a shift in the charitable world and the gifting. I don't know if it in 2020, as some of you may know, 501c4s no longer have to disclose their donors on Schedule B. I don't know if that had any influence, but or if it's just those that are charitable minded and not as driven by the charitable deduction. But we've definitely seen with organizations like Patagonia, that was in the news a lot, of creating their trust for public benefit. There's definitely been that shift.
Yeah, I think what I've seen is historically there have been, we've seen public charities with the classic kind of triumvirate of organizations of a 501c3 public charity that then has an affiliated 501c4 and has an affiliated political action committee. And that has been something that we've seen for a long time in the public charity, into lobbying, into political activity, affiliated organization structure. The shift that I've really seen more now is in donors and in families who are looking at how to structure their ways to make impact. And I'm seeing more folks who say, I would like to set up a private foundation, maybe also a supporting organization, but then also a 501c4. I think the piece that's also part of that is the not paying gift tax. It's a way to transfer assets out of somebody's personal holdings so that it wouldn't be held by the estate, so they can make this lifetime transfer from individual into the C4, and that the C4 doesn't have some of these issues that are harder for donors, like excess business holdings. And so that's really been a tool to be able to transfer certain types of assets, but also to be able to make that additional impact. So I think the shift again that I'm seeing is there have always been the C4s for more sophisticated charity C4 political action committee kind of triumvirates, but now what we're really seeing is more donors and family groups saying, I want to make an impact in a couple different ways. I'm going to transfer some funds and get the charitable deduction to my private foundation, and some funds to a C4. And by transferring them from me personally into the C4, these funds have never been tainted with all of the C3 rules that we just talked about. So they have that greater flexibility of being able to do more things in the lobbying and the political activity. And so that's really been an exciting way, I think, to see some different folks really lean more into the C4 world to make impact in that additional approach and kind of have that additional piece in the pocket for a family and donor.
Thank you. So I do want to remind folks that on this last slide of ours, under IRC 5027B, there is tax on exempt function activities for these organizations. An exempt function is defined as the function of influencing or attempting to influence the selection, nomination, election, or appointment of any individual to any federal, state, or local public office or office in a political organization. And this tax is the lesser of the net investment income for the taxable year or the aggregate amount of expenditures for exempt function activities during the year. And so this treatment applies whether an organization makes the expenditures directly or through another organization, is a good reminder. I know we have about 8 minutes left. So Wendy, are there any audience questions?
Yes, I was just scrolling through. I want to go to some of the older ones first that they asked very early on in the presentation. So one is, I've seen large mega churches invite a political candidate to speak at the Sunday sermon, but not the opposing candidate, or the minister publicly endorse a candidate. Are churches held to a different standard?
That is a great question.
Yeah, I think it is a good question. I think there's a lot of conversation about what churches do and don't do. There have been some cases, I think, on this topic as well. We didn't delve into churches specifically, but I think it gets into legal issues of, church and state and tax exemption and more. It's a big topic, but I don't know. Wendy, do you have a succinct answer that you would provide to that question?
Well, I think just to make it clear for the audience, a church is a 501c3 organization, although they don't have to apply for exemption like public charities, private foundations do, but they do have that same exemption. But like Saskia said, there are some very unique rules around churches and ministers in particular. I am not aware of them being exempt from being able to do political activity and spend, having a candidate of one side at an event and not another. But I think that is an area that I'm not quite as familiar with. I think, Maggie, you mentioned with the 501H election, I think you did mention something on churches there.
They cannot elect. I know that. And I think the churches I find also interesting because they don't file a Form 990, right? So this information, unlike for other organizations that you could just easily find online, isn't readily available. So It's not as clear, right, where you could look at a organization's 990 and look at their activity and immediately on the functional expenses, see what they're spending on lobbying, for example, or Schedule C for more detail on that. We have no such visibility for churches.
Yeah,
and
I'll just add.
This is more of an issue really of some enforcement, and I think that was kind of my more vague answer of no. The answer is, no, that churches don't have exemptions, right? They are C3s and have the same rules as Wendy led with. I think it's a question of the enforcement, right, of doing those, and the enforcement mechanism for these rules often is the 990 filing and through the IRS, so it just gets more confusing. But I think we can all identify examples where churches are treading into providing voters pamphlets and more that's beyond what's appropriate for a 501c3.
Yeah, I agree. All right, let's see. Can a private foundation provide a letter of support to a grantee, in this case public charity, who is lobbying for legislation so long as it does not include a call to action?
So the answer for me for that would be no, because it sounds like my assumption is that you're writing this letter for a charity to include in a packet of material to go to the legislator, which would be the ultimate audience, to get some sort of support. And so if you're, providing yes, I'm on board with their request, please do this legislation, that has an audience of a legislator at the end versus an audience of, the general public. And so there would be a call for support is what is required with that content when it's going to a legislator. So kind of thinking through what the ultimate audience is in preparing that, you get into this. The IRS actually does have something called direct lobbying. Leave it to the IRS to have something like that. But that ends up being what that is, of the ultimate piece of getting to the legislator. And I tell people, don't try to be sneaky, but there may be ways that you could still express that support in a way that is not that sneaky workaround, but some other way into the general public that you could give some other support rather than trying to get a letter in that would go ultimately to a legislator.
Okay. As a private foundation, can our primary funder's government affairs team meet with government officials, candidates, work to include funding and legislation that funds programs for one of our initiatives? Funding's not direct to the private foundation, but one of our grantees that implements the program. And I know that's a lot of information, so if we need to follow up on that one, just let me know.
That may be a follow-up. I'm guessing from looking at that there could be a company or maybe a corporation with a corporate foundation that's then funding different pieces. But I think I need to draw out what is happening. But if it is a corporation with a corporate foundation that has grantees, and the corporation and its corporate government affairs team is doing its own corporate affairs work, there are ways to structure that, of course, so the company is doing its work. It's independent of the foundation, but that sounds like it's got some details that we can follow up with the after offline.
Agree. All right. What changes are there, if anything, if the private foundation works with a lobbying organization? So indirect versus direct, if that's even a thing.
So I'm not quite sure, what that is exactly asking. I think if the private foundation is working with a charity that's lobbying or with a C4, I think, it's figuring out how you're structuring different types of collaborations and really how you're not only structuring your work, your communications, your, collective work is really important, but I'm happy to talk with that person offline and get a little more understanding about what they're asking.
All right, I think we've got one more.
Yeah, and one thing, since we have only a minute left, so before Wendy wraps up, I think going back to that question about the government officials, I think, and please feel free to follow up with us as well. But I think there's, Saskia, correct me if I'm wrong, but I think there's a special exception for private foundations that they could discuss jointly funded, programs with there's private foundations jointly funding with the government, but that's the only thing that comes to my mind.
Yeah,
okay,
and it's a pretty narrow exception with that as well. So I think that's one that's hard to rely on, but I think that Wendy, Maggie, and I are also happy to follow up with your questions.
Great. Well, thank you very much, Saskia and Maggie. This has been a great session, and we've got a few questions that we, just so everyone knows on here, we are intending to follow up on questions after the conference, so we will compile those. I will turn it back over to Amy to close us out for a break.
All right. Well, thank you to all of our morning session presenters. And then to our audience, join us for the afternoon session starting at 1 o'clock Pacific time. You can click on the widget located in the upper right-hand corner of your console now, and that will direct you to the afternoon console, or you can use the login link that's found in your calendar appointment. And again, thank you for joining us, and enjoy your break, everyone.